The world of cryptocurrency is rapidly expanding, evolving into a new frontier of finance. However, this nascent landscape can feel like uncharted territory, especially for newcomers. Market charts are visual representations of price data over time, providing a historical record of a cryptocurrency's performance. By analyzing the patterns and trends within these charts, traders and investors can make more informed decisions. Line charts, bar charts, and candlestick charts are among the most commonly used. Candlestick charts, with their unique candle-like structures, offer a wealth of information at a glance. By learning to interpret these visual cues, traders can gauge market sentiment and anticipate future price movements. Mastering the art of reading market charts requires patience and dedication. A solid understanding of market charts empowers individuals to navigate the cryptocurrency market with greater confidence. Navigating the cryptocurrency market requires a keen understanding of its language, a language expressed through charts and graphs. For those who can decipher their patterns and trends, market charts offer invaluable insights into the forces shaping the cryptocurrency landscape. Line charts are often the first point of contact for individuals venturing into the world of market analysis. These charts provide a simple and straightforward representation of price movements over time. By connecting the closing prices of a cryptocurrency at regular intervals, line charts create a continuous line that visually depicts the overall trend. For traders seeking a more comprehensive understanding of price action, more detailed chart types such as bar charts and candlestick charts are essential tools. Bar charts, also known as OHLC charts, open, high, low, close, provide a more in-depth look at price action compared to line charts. Each vertical bar on a bar chart represents a specific time interval, revealing the opening price, closing price, high price, and low price within that period. By visualizing the price range for each interval, bar charts offer valuable information about price volatility and market sentiment. The relationship between the opening and closing prices provides insights into buying and selling pressure during that period. Candlestick charts offer a more nuanced and visually engaging representation of market dynamics. Developed in 18th century Japan by rice trader Munehisa Homa, candlestick charts have stood the test of time. Each candlestick on a chart represents a specific trading period, revealing the opening price, closing price, high price, and low price within each period. At the heart of a candlestick chart lies the candlestick itself, a seemingly simple structure that holds a wealth of information. Each candlestick comprises two main components, the body and the shadows, also known as wicks or tails. The body represents the range between the opening and closing prices of the trading period. Extending above and below the body are the shadows, thin lines that depict the price extremes reached during the trading period. The color of a candlestick's body provides a valuable visual cue for gauging market sentiment. A white or green candlestick generally indicates bullish sentiment. Buyers are in control. Conversely, a black or red candlestick typically reflects bearish sentiment. Sellers are dominant. The ability to quickly discern bullish and bearish candlesticks at a glance is a key advantage of using candlestick charts for technical analysis. Candlestick charts reveal patterns that offer valuable clues about potential market movements. Recognizing and interpreting candlestick patterns is an essential skill for any trader. By understanding these patterns, traders can make more informed decisions about entry and exit points, stop-loss levels, and overall trading strategies. Among the most widely recognized candlestick patterns are the bullish engulfing and bearish engulfing patterns. A bullish engulfing pattern suggests that buyers have stepped in forcefully, potentially signaling a shift from a downtrend to an uptrend. Conversely, a bearish engulfing pattern indicates that sellers have taken control, potentially marking a shift from an uptrend to a downtrend. To recognize a bearish engulfing pattern, Look for a smaller green candlestick followed by a larger red candlestick that completely engulfs the green one. This pattern typically appears at the end of an uptrend, signaling a potential reversal as selling pressure increases. The doji candlestick represents a moment of indecision in the market. A doji is formed when the opening and closing prices are virtually equal, resulting in a candlestick with a very small body or no body at all. The doji generally indicates a stalemate between buyers and sellers. The appearance of a doji can signal a potential trend reversal or a period of consolidation. Understanding price trends is paramount to successful trading. These trends dictate the overall direction of the market, influencing the decisions of traders and investors. Recognizing these trends early on can give traders a significant advantage. An uptrend, often referred to as a bull market, is characterized by a sustained upward movement in price. On a chart, an uptrend is visually represented by a series of higher highs and higher lows. Higher highs occur when the price reaches a new peak that is higher than the previous peak. Higher lows happen when the price drops but stays above the previous low, indicating that buyers are stepping in at higher levels. In contrast, a downtrend, also known as a bear market, is marked by a persistent downward trajectory in price. Lower highs occur when the price peaks but does not reach the previous high. Lower lows happen when the price drops to a new low that is lower than the previous low, indicating that sellers are in command. Sideways trends, also known as consolidation or ranging markets, signify a period of indecision. During a sideways trend, prices fluctuate within a relatively narrow range. This pattern suggests a balance between buying and selling pressure. Some traders may choose to sit on the sidelines during these periods, waiting for a breakout from the established range. Navigating the complex world of cryptocurrency trading requires powerful tools for analysis. Among the most essential of these tools are charting platforms. Popular charting platforms like TradingView, Coinigy, and the native tools provided by crypto exchanges offer a suite of features. These platforms provide real-time data and allow traders to visualize price movements through various chart types. This level of customization is crucial for spotting trends and patterns that might otherwise go unnoticed. Technical indicators are indispensable tools for traders looking to understand market momentum and predict future price movements. Some of the most widely used indicators include moving averages, relative strength index, and moving average convergence divergence. Moving averages help smooth out price data to identify the direction of the trend. The relative strength index measures the speed and change of price movements. An RSI above 70 indicates that an asset is overbought, while an RSI below 30 suggests it is oversold. The moving average convergence divergence helps in identifying changes in the strength, direction, momentum, and duration of a trend. Section 3. Volume Analysis, Confirming Trends and Patterns. Volume analysis is a critical component of technical analysis, providing insights that are not available through price data alone. Volume refers to the number of units traded during a specific time period and is often displayed as vertical bars at the bottom of a chart. High trading volume during price movements can confirm the strength and sustainability of a trend, while low volume may indicate weakness. For example, if a cryptocurrency breaks out of a consolidation pattern on high volume, it suggests that the breakout is likely to be valid and sustainable. Conversely, if the breakout occurs on low volume, it may be a false breakout, likely to reverse. Similarly, during a price rally, increasing volume indicates strong buying interest, while decreasing volume suggests weakening momentum. Volume indicators like on-balance volume and volume price trend provide additional layers of analysis. On-balance volume measures cumulative buying and selling pressure by adding volume on up days and subtracting it on down days, helping to anticipate price movements. Volume price trend, on the other hand, combines price and volume data to identify trends and potential reversals. By integrating volume analysis with other technical indicators and chart patterns, traders can develop a more comprehensive understanding of market dynamics. This holistic approach enhances their ability to make informed trading decisions, ultimately improving their chances of success in the volatile cryptocurrency market. Section 1. Navigating the Charts, a beginner's guide. Embarking on cryptocurrency trading can feel like stepping into a labyrinth of charts and indicators. For beginners, the volume of information can be overwhelming. Mastering chart reading begins with a solid foundation and consistent practice. Start with the basics. Familiarize yourself with candlestick charts. Understand each candlestick's meaning and basic trends. Focus on one time frame at a time. Start with the daily chart. Gradually add more time frames as you gain confidence. Focus on understanding bullish and bearish sentiment, support and resistance levels. With experience, you'll recognize recurring patterns. Section 2. Refining your approach. Tips for continuous improvement. Chart reading is an ongoing process of learning and refining your approach. Consider these tips to enhance your chart analysis skills. Practice with a demo account. It provides a risk-free environment to test strategies. Use a combination of indicators. Incorporate moving averages, RSI, and MACD. Avoid cluttering your charts with too many indicators. Stay informed about market events. Cryptocurrency markets are sensitive to news. Join a trading community. Engage with other traders for insights and support. Always conduct your own research before making trading decisions. Section 1. Charting your course to success. As we conclude our exploration of market charts in the cryptocurrency realm, it's essential to emphasize that mastering this skill is not merely about memorizing patterns or blindly following indicators. It's about developing a deep understanding of market dynamics, cultivating patience and discipline, and embracing a continuous learning mindset. Chart analysis, at its core, is the art of extracting meaningful insights from the visual representation of price data, enabling you to make more informed trading and investment decisions. Remember that the cryptocurrency market is a dynamic and ever-evolving landscape, influenced by a multitude of factors, including technological advancements, regulatory changes, macroeconomic trends, and even social sentiment. Charts provide a valuable window into this complex ecosystem, allowing you to track price movements, identify potential opportunities, and manage risks effectively. By integrating the knowledge and skills you've gained from this guide, you'll be better equipped to navigate the exciting, albeit volatile world of cryptocurrency trading. Section 2. The Journey of a Crypto Trader. The journey of a cryptocurrency trader is rarely linear. It's often characterized by both triumphs and setbacks. There will be times when your analysis aligns perfectly with market movements, leading to profitable trades, and there will be times when the market seems to defy all logic, challenging your understanding and testing your resilience. Embrace these experiences as valuable learning opportunities, constantly seeking to refine your approach and adapt to the ever-changing market dynamics. Don't be discouraged by initial setbacks or intimidated by the complexity of technical analysis. Start with a solid foundation. Focus on mastering one concept at a time and gradually expand your knowledge base. Remember that even experienced traders were once beginners, navigating the same learning curve. With dedication, perseverance, and a willingness to learn from both successes and failures, you can develop the skills and confidence to thrive in the cryptocurrency market. Section 3. Embrace the learning process. The world of cryptocurrency trading is constantly evolving, with new technologies, trading strategies, and market trends emerging regularly. Embrace this dynamic environment as an opportunity for continuous learning and growth. Stay abreast of industry developments, explore new analytical tools and indicators, and never stop seeking ways to enhance your understanding of market dynamics. Remember that knowledge is power, especially in the fast-paced world of cryptocurrency trading. The more you learn about market charts, technical analysis, and risk management, the better equipped you'll be to navigate the complexities of this exciting market and capitalize on the opportunities it presents. So, embrace the learning process, stay curious, and never stop seeking ways to improve your trading skills. The journey of a cryptocurrency trader is one of constant evolution, and the rewards often go to those who are adaptable, resilient, and committed to lifelong learning. As we wrap up this journey through the fascinating world of cryptocurrency trading, we hope you found valuable insights and tools to enhance your trading skills. Remember, the learning process never stops, and staying informed is key to success in this dynamic market. If you enjoyed this video and want to continue exploring the depths of crypto trading, please subscribe to our channel and like this video. By subscribing, you'll stay updated with the latest content, tips, and strategies to help you navigate the ever-evolving crypto landscape. Thank you for watching, and we look forward to having you with us on this exciting journey. Happy trading!